Hey there, future millionaires. Ever wonder how to turn your hard-earned cash into a mountain of moolah? We're talking serious wealth here, the kind that makes your neighbors jealous and your dog wear a diamond collar. It's a question as old as time, or at least as old as the stock market. Do you play it safe and watch your money slowly grow with dividend investing? Or do you swing for the fences and pray for a home run with growth stocks? We're getting the answer to that very question. Buckle up, Buttercup, because we're about to break down two of the most popular investing strategies and see which one comes out on top. Hit the like button on this video. It helps us get more videos out to you in the community. First up, we've got the reliable workhorse of the investing world, dividend stocks. Think of these bad boys as the tortoises of the market. They might not be flashy or exciting, but they just keep chugging along, spitting out cash like a Pez dispenser on overdrive. Dividends are basically a way for companies to share their profits with their loyal shareholders. It's like getting a little bonus check every quarter, just for owning a piece of the pie. Not too shabby, right? Now you might be thinking dividends sound kind of boring. Where's the thrill? Where's the risk? And you wouldn't be entirely wrong. Dividend investing is generally considered a more conservative approach, favored by folks who prioritize stability and income generation over rapid growth. But don't let that fool you into thinking dividends are for the faint of heart. There's a certain beauty to watching your money steadily compound over time, like a snowball rolling down a hill getting bigger and bigger with each passing year. Now, for those who crave a little more excitement in their lives, we have the daredevils of the investing world growth stocks. These are the companies with their eyes on the prize, constantly innovating and expanding, aiming for the stars, and hopefully taking your portfolio along for the ride. Growth stocks are all about potential. These companies are often young, dynamic, and disruptive, operating in industries that are expected to experience rapid growth in the years to come. Think tech companies, renewable energy, biotech, you name it. If it sounds like the future, it probably has a growth stock attached to it. Of course, with great potential comes great risk. Growth stocks can be volatile, their prices fluctuating wildly based on market sentiment, news headlines, and the occasional tweet from a certain billionaire with a fondness for emojis. But for those who can stomach the roller coaster ride, the rewards can be astronomical. Just imagine getting in on the ground floor of the next Amazon or Apple. Your early investment could multiply many times over, making you the envy of every Wall Street hotshot. Here is the breakdown these dividend payments even further. Visualize a company raking in the big bucks. Now, they've got a couple of options. They can reinvest that cash back into the business, hoping to fuel further growth, or they can share a chunk of it with their shareholders. That's where dividends come in. Think of it like this. You buy a slice of a juicy apple pie, that's your stock, and every so often, a little dollop of whipped cream magically appears on top. That's your dividend payment. A sweet little bonus for being a loyal investor. Now, not all companies pay dividends. Some companies, particularly those in their growth phase, prefer to reinvest all their earnings back into the business. They're more focused on expanding their operations, developing new products, or conquering new markets. But other companies, often those that are more established and have a steady stream of profits, see dividends as a way to reward their shareholders and attract long-term investors. It's like saying, hey, we appreciate you sticking with us, so here's a little something extra to sweeten the deal. Among dividend-paying companies, there's an elite group known as dividend aristocrats. These are the royalty of the dividend world, companies that have consistently increased their dividend payments for at least 25 consecutive years. Talk about commitment. These dividend aristocrats are like the marathon runners of the stock market. They just keep going and going, no matter what the economy throws their way. They've weathered recessions, market crashes, and even the occasional pandemic, all while continuing to hike those dividends. Investing in dividend aristocrats is like having a reliable friend who always remembers your birthday and never shows up empty-handed. You can count on them for a steady stream of income year after year. Some well-known dividend aristocrats include companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble, household names that have been around for decades, providing products we use every day. Dividends do the heavy lifting. The power of compounding in dividend investing is like a snowball effect. Reinvest dividends to generate more dividends, creating a magical money-making machine. Over time, this can turn a modest investment into a substantial nest egg. Consistency and patience are key, like the tortoise and the hare. Some people might think that dividend investing is just for retirees or folks nearing retirement, but that's a common misconception. While it's true that dividends can provide a steady stream of income during retirement, they can also be a valuable tool for younger investors. For starters, dividends can help to cushion your portfolio against market volatility. When the market takes a downturn, as it inevitably does from time to time, those dividend payments can provide a source of income and help to offset some of your losses. Plus, reinvesting dividends in your younger years allows you to take advantage of the power of compounding for a longer period, potentially leading to a larger nest egg down the road. It's like starting to save for retirement in your 20s. The earlier you start, the more time your money has to grow. So, whether you're a seasoned investor or just starting out, don't underestimate the power of dividends. They can be a valuable tool for building wealth over the long term, regardless of your age or risk tolerance. Let's switch gears because now we're deep into the fast-paced world of growth stocks, the daredevils of the investing world. These are the companies that make headlines, disrupt industries, and have the potential to turn your portfolio into a goldmine, but no promises, of course. Growth stocks are like the thoroughbred racehorses of the market. They're built for speed and agility, always pushing the boundaries and aiming for the finish line, which, in this case, is massive profitability. They're not content with just maintaining the status quo, they want to change the game entirely. These companies are often driven by innovation, new technologies, or a unique approach to solving problems. They're the ones coming up with groundbreaking products and services that we didn't even know we needed, but now can't imagine living without. Think about companies like Tesla, revolutionizing the automotive industry with electric vehicles, or Amazon, transforming the way we shop and consume entertainment. These are the kinds of companies that get investors excited, the ones that promise to change the world and hopefully make you a pretty penny along the way. When you think of growth stocks, tech companies are often the first to come to mind. And for good reason. The tech sector has been a breeding ground for some of the most successful growth stories in recent history. Think about it. Smartphones, social media, cloud computing, artificial intelligence. These are all game-changing innovations that have fueled explosive growth in the tech sector. And as technology continues to evolve at a breakneck pace, the opportunities for growth seem almost limitless. But it's not just about tech anymore. Growth can be found in various sectors, from renewable energy and biotechnology to e-commerce and sustainable living. The key is to identify companies that are disrupting their industries and riding the wave of future trends. Look for companies with a clear vision, a strong track record of innovation, and a large potential market for their products or services. These are the companies that are most likely to deliver those eye-popping returns that growth investors crave. Caution: before you go all in on growth stocks, it's crucial to remember that high growth potential often comes with a side of volatility. These stocks can be like riding a roller coaster, exhilarating highs and stomach-churning lows. Growth companies are often unprofitable in their early stages, as they invest heavily in research, development, and expansion. Their stock prices are driven more by speculation and future expectations than current earnings, making them susceptible to wild swings based on market sentiment and investor confidence. A single news headline, a product launch, or even a tweet from a prominent influencer can send growth stock prices soaring or plummeting. This volatility can be nerve-wracking for even the most seasoned investor, so it's essential to have a strong stomach and a long-term perspective when venturing into the world of growth investing. Remember, growth stocks are not for the faint of heart. They require a higher risk tolerance and a willingness to ride out the inevitable ups and downs of the market. But for those who can handle the heat, the potential rewards can be substantial. So you may be thinking, how do you separate future Amazons and Teslas from those destined to fade? Look for companies with strong management and a competitive edge. A growing market provides room for expansion. Examine financials for consistent revenue growth. Careful research and intuition are key. It's like panning for gold patience, and a keen eye might strike it rich. Dividend stocks versus growth stocks, a head-to-head showdown. Get ready because it's time for the main event. Dividend stocks versus growth stocks. Which strategy reigns supreme? It's the ultimate investing showdown, and we're here to break it down, round by round. In this corner, we have the steady and reliable dividend stocks, known for their consistent payouts and ability to weather market storms. They're like the veteran boxer, experienced, disciplined, and always ready to go the distance. And in the opposite corner, we have the dynamic and potentially explosive growth stocks, promising rapid appreciation and the chance to turn a small investment into a fortune. They're like the young, hungry boxer, eager to prove themselves and land that knockout punch. So, who wins this epic battle? Well, the truth is there's no clear-cut winner. It's like comparing apples and oranges. Both are delicious and nutritious, but they offer different flavors and benefits. The best strategy for you depends on your individual financial goals, risk tolerance, and time horizon. It's like choosing a boxing match to watch. Do you prefer a tactical battle of attrition or an all-out slugfest? So let's figure out which one may be best for you. When dividends shine and growth stocks stumble. When the market throws a tantrum, dividend stocks often shine. Think of them as the sturdy ship navigating a stormy sea. Dividend-paying companies tend to be more established and financially stable. Growth stocks, on the other hand, can be more susceptible to market downturns. Their valuations are often based on future expectations, which can plummet. If you lose sleep over market dips, dividend stocks might be a better fit. Another important key to figuring out which type of investing works for you, the time horizon and your investing strategy. Your time horizon is like planning a road trip, quick joyride, or cross-country adventure. Longer timelines let you ride out market fluctuations and benefit from compounding. For retirement, decades allow for more risk. Growth stocks offer higher returns. Shorter retirement horizons prioritize less risk and more capital preservation. Dividend stocks provide steady income. Investing isn't one-size-fits-all. Your approach depends on your goals and risk tolerance. Diversification is the secret sauce to a well-balanced investment portfolio. Just like you wouldn't eat the same meal every day, don't put all your hope in one stock. Spread your investments across different asset classes, sectors, and geographies. It's like having a backup generator. If one fails, another picks up the slack. Diversifying reduces risk and enhances returns. If one sector underperforms, others can offset the losses. You can also create a portfolio with both dividend and growth stocks. Benefit from the stability of dividends and the potential for growth. Hold on, we must talk about the importance of investor psychology. It's a wild ride through the ups and downs of human emotions where fear and greed duke it out in the ring of the stock market. You see, investing isn't just about numbers and charts. It's about understanding how our brains work and how our emotions can influence our financial decisions. It's like trying to predict the weather. Sometimes it's sunny and predictable, other times it's a chaotic storm of emotions. Our brains are wired to seek pleasure and avoid pain, which can lead to some interesting and sometimes irrational behaviors when it comes to money. We get excited by the prospect of big gains and terrified by the thought of losses, even if those losses are just on paper. Understanding your own psychological biases and tendencies is crucial for making sound investment decisions. Knowing your strengths and weaknesses as a poker player, you can't win if you don't know when to hold them and when to fold them. So what about risk tolerance? It's the daredevil versus the cautious investor. Choosing between riding a roller coaster or a leisurely Ferris wheel, both offer unique experiences, but the thrill level is quite different. Some people, bless their adventurous souls, thrive on the adrenaline rush of high-risk investments, the evil Knievels of the investing world, fearless in the face of volatility, chasing those massive gains with a glint in their eye. Others prefer a more conservative approach, like a gentle stroll through the park, compared to a wild jungle expedition. They prioritize capital preservation and steady growth, even if it means sacrificing some potential upside. There's no right or wrong answer when it comes to risk tolerance. It's about understanding your comfort level with market fluctuations and potential losses. Similar to choosing your spice level at a restaurant, some like it hot, others prefer mild, and that's perfectly okay. Okay, it's time for some introspective soul searching. If you're a free spirit who thrives on excitement and innovation, a growth-oriented portfolio might be right up your alley. You're comfortable with volatility and view market dips as buying opportunities. You're in it to win it, baby. If you're more risk-averse and prefer the comfort of predictability, a dividend-focused strategy might be a better fit. You're content with slow and steady growth and appreciate the peace of mind that comes with a regular stream of income. And of course, there's a whole spectrum in between. You might find that a balanced approach with a mix of growth and dividend stocks suits your personality best. It's all about finding that sweet spot where you feel comfortable and confident in your investment decisions. As I stated before, investing is a marathon, not a sprint. It's about finding a strategy that aligns with your personality, your goals, and your risk tolerance, and then sticking with it for the long haul. So, we've journeyed through the exciting, sometimes bumpy terrain of dividend versus growth investing. And the verdict? It's a tie. No stock-picking crystal ball can tell you definitively which strategy will make you richer. Investing, much like picking out the perfect pair of shoes, ain't one size fits all. What's comfy for one person pinches another. Just like those fancy Italian loafers might make you the envy of the office, they won't do you much good if you're trekking through the Amazon rainforest. The beauty of it all? You get to choose the path that aligns with your financial goals, risk appetite, and yes, even your personality. Are you the type who sleeps soundly knowing your investments are churning out steady income like a well-oiled machine? Or do you get a thrill from the potential of your portfolio skyrocketing like a SpaceX launch? Neither approach is inherently better. It's all about understanding the trade-offs and picking the path that best suits your unique investor DNA. So, how do you actually put this wisdom into action and build a portfolio that wouldn't make Warren Buffett cringe? Think of it like constructing a sturdy house. You need a solid foundation of core holdings, like those blue-chip dividend payers we talked about, the ones that have stood the test of time through thick and thin. These are your reliable tenants, paying rent, or in the stock market like dividends, which would occur rain or shine. But you don't want your whole house to look like a retirement home, do you? Spice things up with some growth-oriented investments, the ones with the potential to turn your modest bungalow into a beachfront mansion, a metaphorical mansion, of course, unless you're already swimming in stock options. Think of these as your high-ceilinged additions, the ones with the potential to really boost your portfolio's value. Make sure to write in the comments below the secret word of the day, DNA. Just remember, even the most beautifully designed house needs regular maintenance. Keep an eye on your investments, rebalance when needed, and don't be afraid to make adjustments as your life changes. And check out the next video I selected just for you to watch next.